Good morning, everyone. It's 29th March 2017, and welcome to this episode of ProAMT Traders Digest. Instead of just going through the digest and uh, marking my observations, what I'll do is today we'll go through the process that how to reach those levels, how to expect what. Basically, it's not some rocket science. It's various reference levels, the depending on the structure of the market, and then not just based on the info, but also having that feel that how is the market performing recently, and what was the intraday move uh, doing, how was it shaping up. Was it finding supply when it's going lower, or was it finding supply when it's going higher? Is it maintaining the demand when it goes high? So, keeping all those parameters and observations in mind, because when you look at the chart, it's not necessary that what you look is exactly what would have happened, because after it happens on a 5 minute bar, you don't know what happened within that 5 minute. At each 1 minute, there might be supply overpowering demand, and the 5 minute as a whole would look like a up bar with volume, which actually points to strength. Now, with the order flow, even afterwards, we can say that okay, there was positive delta or positive order flow in that bar. So, obviously, inside it would be demand and not supply. But if you are watching it live, you come to know that when did that delta actually rise, because in 5 minutes it can be a 20-30 point move, and from that 30 point move the delta would have gone positive just at the highs, and that's a sign of weakness, that's not a sign of strength. So based on the observations intraday and how it behaved, we try to either, if somebody wants, they can note down what was happening during the day, and that is the reason for preparing the prep sheet, so that next day we can know that what levels were working as demand and supply during the previous day. So first let's go into the chart and see. So now on 27th, let's have a look initially in this profile and see what would we expect for today. So the first sign is open within the range. Open within the range of 24.3. So it's not a directional open, it's a non-directional open. Now, if we just consider the open, we would be thinking that there will be no trend. But if we keep on watching it, how it performed after the open, we come to know that okay, it opened and directly pushed lower. And where did it go? Exact reference. Again, here what sign you get is a bad reference, a weak low. Now the market has just opened. It has directly pierced into the POC. How to define that it's a weak low? Going to mechanical levels is not the sign of other time frame or long term players. They do not like those mechanical levels. So what do we expect here? We expect the market to pull back. Now this has pulled back. It's not necessary that it will pull back, but it's a general observation that after such a spike it tends to pull back to find any supply higher. And where would be a good point? I would consider either 50% of this range or the point of control. So the point of control was here, it looked above and it fails. Now, when it fails, we'll not come to know from here, we'll come to know at the breakdown. Now, breaking and goes below. So it has gone below and reached into this spike. When it reaches into this spike, it gives a sign of a auction failure. So C period breaks down from the initial balance, again goes back in. So there we would feel that, okay, no, this is uh, like a auction failure, and we might like directly drive higher. But that doesn't happen. What it does is it keeps on pulling back to the point of control, and it fails and falls down. Now when it's falling down, we need to again watch how it is doing, because there is the previous week's low here. So it went there, consolidated there, H period gave a breakdown and came back in. Now this point is what we want to see on a smaller time frame chart, that is there any sign here which can tell us that this is going to reverse. Now in the prep part, we would not assume that it went here, but if anybody would have watched the digest of this day, I was expecting a visit of the VWAP in case it breaks down. Now whether it will break down or not is not sure at all, but now after this information we know that if it's breaking down, the point of interest is around 9043, which was the monthly VWAP. Now it might go 2 or 3 points higher and reverse back, it might go further lower and reverse back, anything can happen. So the reason to have that point of interest is that when it reaches there, we should be alert and see what is happening. Now at times it might go down, again bounce back, go 30 points up and again fall back. So when it falls back, we need to again watch what it is doing when it went up. So cannot just like rely on one information and say that, because during the day many times it happens, like today it was happening that it went higher, and we think where would it go. The POC shifts higher. The POC shifting higher is not a sign that it's getting accepted. To get accepted, it needs to build value there. So if it would like want to get accepted completely here initially, it would have done a zigzag move, and generally orderly auction generally goes this way. So A period would go like this, B period would extend a bit further, C period would extend a bit further, D period would extend a bit further. So everything would be like almost overlapping. It would not even make a weak reference, but still would overlap a bit and gradually go higher. And that is a sign of serious money buying into that rise. When this is happening, it's rising in a spike, that's not serious money. So we keep on watching what happens when the auction revisits this place or fails here. So this failed. Now when it fails, again we need to watch on a smaller time frame what might happen. And then this is where the references come handy. The reference here, how would you consider a reference? So first reference is just zoom out. When you zoom out, we'll be able to see a clean picture. So here if we can see, this is a balance, this is almost a balance. So from here we divide it as a upper and lower balance. So above this is upper balance, below this is lower balance. So first point of interest is this, and also happens to be above the previous day's high. So that would be a good point of interest. Now when it's going there, we want to see what it fetches. So it has pushed above that reference, fails, again tries to push, fails. Now it's not trying to push. So that means that two efforts at 30-minute interval have failed. Now, how would it look on 3 minutes? It came down, tried to reverse back, and fails. So here we know that if this has failed, there are all chances that we revisit this balance. At that moment, we either need to have a prior established reference, or the current information is that we'll reach somewhere into this. So in case we are going short, our objective is to initially book out 50% of the position here, because we don't know whether it will extend or not. Now, from here, when it pushes down and reverses, what can we expect then? Then we expect it to go into this balance. This balance first, it can go even higher, but the primary objective is to go into a balance which it has created on a smaller time frame. Now, do we get the same reference on the 30-minute chart? Let's first see that. So that's 9110, and we had the point of control there earlier from where it shifted. So that is one of the references. Now, what it does and how it does is not controllable, because every time the question arises, okay, if it is doing like this, then will it do like that? We can make a best assessment. We cannot exactly predict, and there is no such rule that it has to happen. There is a probability. And how do we calculate the probabilities and see whether they will work in our favor? Is like, I would suggest doing a point rating system. So here, what would you think is, how is it pushing up? Is it pushing with volume? Excessive volume is bad for the rise, because when the participation is very high, that means the supply is also coming in. Participation will be high when there are sellers also, because a buyer needs to buy from a seller, and if that seller is comfortably selling even higher levels, that means there is supply existent. If there was just demand, the volume would not be excessive, because fresh buyers would be less, and the buyers from the accumulation zone would be buying a bit to keep the auction trading higher. So any minor selling that comes on the way, they would be just taking out, because they already, suppose somebody wanted to buy 10 lakhs, and yeah, he has already got 7 lakhs, 3 lakhs he can still buy, so he has buying power left. So while the auction is moving up, what he does is, anyone willing to sell higher, they keep on buying from them, so that automatically the price can go higher. So we need to observe what it is doing. Then the second thing is, if there is supply, is it proving that the supply is real and it can stall the auction? To know that, it will go for a test, and the test can be on a 1 minute, also can be on a 3 minute, can be on a 5 minute. At times it might take an hour to test, at times it might test in within 10 to 15 minutes. From that, we need to classify which kind of tests generally work in which kind of environment. So again, to understand the thrust and test is very easy, but to get the hang of it, that while it is happening, we need to get that feel of the market to understand, if it is doing in a certain condition, it might turn out to be in a particular way, and if it is doing in some other conditions, it might not work, because we cannot define that this is going to work and that is going to work. We need to observe it for few days, and then either note it down, or start marking it instantly when that is happening, that okay, if this is like this, the likely scenario can be like this. So that is the way we develop our trading bias and a trading system, because Once you are assuming that after this test it might fall down, that means that you are already short biased into that trade. Now the probability is that after the test, or even the test does not happen and it pushes even further higher, but because of few reasons we are able to justify that the higher probability is of going down. And if the higher probability is of going down, you create a short, because there is no way that we will be able to move the markets until and unless we have that buying or selling power. Here, if the information is saying that there is a higher probability of it going down after a test, we need to just execute the order with keeping in mind that the probability is 50-50, and also see what is the reference higher. If there is a reference higher, so in this case the higher reference was 9135, and there is a reference here of this value area, so it has because see, this is again a day time frame reference. People would be watching this. There might be a low or high here, a congestion low or high. They would be watching that. So that is where you start building up your point system. Say, okay, it's going into this weak reference, but it has failed. So one point is noting a weak reference. The second point is, does it want to avoid going into that weak reference and fall back or not? So again, you give 1 point to that thing, 1 point to this thing. Similarly, if it's a spike, the supply is there, then again a negative mark, because that means the rise is not good. If the rise is not good, what should it do? It should now start dropping volume. Then you observe that the volume is dropping. Okay, now done. So that means the volume is dropping. You add again -1 and +1 on the seller side. So now, after like answering 4 or 5 questions, you will realize that okay, now we are quite convinced that this is going on the sell side. Now when this happens, we don't know in how much time it will happen and how it will happen, but the probability is that it might happen. So we, based on that probability, we enter that trade and wait patiently and watch what it is doing till then, because it might create a new information which is more noteworthy than what we actually saw while entering the trade. So that is what we do during the day. Now, for the prep purposes, for like today's prep, what would we see? The first thing is, how did it open and what did it do? So it opened, marked up higher, and came back a failure below the low. So one important point is noted, that there is a failure below the low. The second important point is a spike into the close. So now entire day's range becomes a spike, a very rare thing, but now the fact is in front of us that the entire day is spike. So in fact we have value, and in other terms we have a spike. That means entire range becomes important. So we'll be looking anywhere inside the range. Anything new information gets generated, we need to react to that information. So for the reference purposes, this becomes very easy, that your high and low is a reference, because entire day is almost a spike. But on other days this might not happen. Now, how to get into a position where you want 2 3 scenarios that what might happen? For that, first thing is, go into a Renko chart and see where is the first zipper. So I would consider this line. This is the zone that I would consider might do something. Where is the second zone that we'll be looking at? This is the zone we'll be looking at. Now, this for a balanced day becomes the value area, the volume based value area. But on other days it might not be the volume based value area, because on this day I would take this as a reference and this as a reference. So on this day it doesn't become the value area. So that is how we find the references, either through zippers, or you can go into a 1 minute, 2 minute, a 3 minute, 5 minute chart, whichever time frame suits. You can go into that chart and then watch out what the market was trying to do in this zone. So here I would say it's trying to see it fell from here, the low is here. So this becomes a reference, and this is as it is a LVN. Then here it's trying to rise, but there is a pullback high here. So this becomes a reference. This is a balance. It falls, starts falling from here, and there is a pullback high here. So this becomes a reference. So that way you can choose your time frame, you can choose how you want to see it, and just mark the demand and supply zones. Now, should be high probability demand and supply zones, should not be like just for the sake of it. There should be some action, and then we mark HVNs and LVNs. So here this is the HVN, and that's all obviously the volume based point of control as well. Here is a LVN, which is exactly like it went into that but rejected. So that becomes a reference that open above that would try its best to go through this area. Now expiry is nearing, so again just getting into the price action or the value or the volume based levels won't work. So for knowing what can be the likely, because see we can assume two or three scenarios, but along with that we need to know that what can be the better probability. So first suppose if we assume a scenario, and I would want like during the market, uh, want to discuss that what everyone else would do. So I would like that we just discusses the as a casual, not a formal webinar, but a casual webinar where everyone gets to like know how would they shape up their mindset for making a tentative plan where it might travel for the next day. So drawing a line here, drawing a line here, drawing a line here, or maybe compress a bit. Okay. So draw a line here, draw a line here, draw a line here, and then lower we can draw one line with this if we want, and another line. The first thing that might is come is this, and which is day before's close. And then the second point of interest is this one, which again is the monthly POC as well. Then above above this zone we have this as the first reference, and above that we have this as the next reference. So this is how I build the levels. Now the confusion about KRA is that what is a key reference area. I would say that anywhere where the auction might react and tend to get the opposite force working, like the opposite force is always sleeping, and any area which could awaken the opposite force is a key reference area for me. So that word, like it's a dicey situation where you use, okay, what is a key reference area? Now there is not a particular key reference area. It cannot be like one level, or it cannot be like I've seen that people call it key reference area but give a single number, that above, buy, below, sell. Cannot be a single number, and can be multiple key reference areas. And I would say that all these demand supply levels are the same thing. They are key reference areas. It's not that we can predict that from this area it will give a 100-point move, and from other supply zones or demand zones it will give only a 20-point move. That is depending on the current information. But when we are trying to analyze, all we can like see is the reference areas, not the kind of move that might develop from there. So in case we now SGX was trading higher, so if SGX is trading higher, we need some confirmation that why was it trading higher and what is the reason here. Is there something visible? Then from the indicators, from the oscillators, you have a divergence here, a positive, so you don't need delta, this much is enough. Then you have a complete positive delta. So this, now though this is falling down, but the way this has built up into this area is like huge build up going into that. If you see, there is, here there was a build up and that created this move. Here there was a build up that created this move, but it failed. So depending on that, first we need to justify that if SGX was trading higher, is there a chance that this can also go higher? Then the first thing is, okay, if it's trading, SGX is trading higher, there is a probability this might also go higher. If this might go higher, then where and how? So for additional confirmation due to the expiry, we need to see the open interest, that what can it target. So let me show you the open interest. So here 9,200 call has the highest OI and 9,000 put has the highest OI. That means the range which we are looking at is capped by 9,200 on the upside, 9,000 on the downside. That is the most likely scenario. Now, the moment the auction reaches there and goes a bit higher, these guys get into panic mode and start covering. At 9,100, the call writers are still dominating. Now, whether they are call writers or not, we don't know. But general assumption is that guys building position in options, the OI increasing, would be short build up, and they are informed, smart people who know how to control the market. Now, the moment they lose control, they also are in panic and run for cover, and that is what causes the prices to inflate further. Now, that is the total OI. We need to see what happened during the day and at the end of the day. What happened to the OI? Let me get it. Yes. So here what happened is 9,100 put OI is added. Now during the day, around double of this was added. So this is 11 lakh 46,000. but during the day 20 lakhs was added almost, and then from there it dropped here. But on the other side, 9100 call OI has reduced, and during the day it was almost half of this. That means whatever the put got reduced, on the other side the call has also got reduced. That means it's adding up a complete effect of positivity. If the call would not have covered, that means the put writers were scared and they are running away. But here the call writers were scared as well, so it obviously adds to double positivity, because the put has added, call has liquidated. Though they shrinked later, though the put y shrink later, the addition, but still now we see this as a double positive. Now where can it go if it's moving above 9100? Where can it go? And this is for the spot rate. So spot going above 9100, where can it go? 9050, 150 has also added a bit. So it will first try to capture 9150, and 9200 call has reduced a bit, but we need more addition into this 9150 to completely stay above 9150. So we need to find a reference level near 9150 and look at that time how the OI is behaving, because at times what might happen during the expiry, the volume spikes can be weird. It can be like rollover spikes coming in. So this will give a added advantage, added information that what is happening when the price reaches that zone. So now once we get all that information, then we create a scenario where, so I would say, to push, so open anywhere from here to here, anywhere it opens. But the first scenario is that it pushes in this manner. Now that is the extreme bullish scenario due to the OI buildup and the delta buildup. And the way we have this, if anyone remembers, I always say that these W's generally like create an impulsive move, and these M's also create impulsive moves. So that can be a likely scenario that it does like this. Now, suppose if it opens gap up above this zone itself, then we consider from here. And why this level? Because of this, because very visual, people would be reacting here. And then the second scenario, if it goes into that level, I want to see how it does into this zone. Does it go above and fail? Or does it go above, stay above, and start going higher? Or it keeps on rotating and nullifies my level? So if this is happening, that means instantly I need to find, okay, why is it doing that? Okay, there is one reference here as well. Okay, there is a reference here as well. So that way I will instantly like find out a reference which I might have missed at times, or I might not have considered as important as the reference which I would have kept on the chart. So then bring that, and a break below that would be a confirmation and not just rotating here. So there we need a confirmation. That confirmation comes, then I would again see what it does into this zone. So one step at a time, it reaches this, might bounce back and continue with this move, or might push inside and check this first. Now how to gauge the inventory, because on the sheet we have inventory. So here it was trading above the close, But what was overnight doing? Overnight is continuously trading above the close, and that means overnight was like trading somewhere here continuously. Overnight is long. When can we get a counter action? Try to push above, fail, and we can get a counter action. So that is another point to be noted. Then how is the structure looking? So structure is like almost a weird balance and a failure here, and there is a upper balance right here. So the structure is like neutral. When we were looking at rest of the stuff, we were looking at it as a positive, and when we are looking at this scenario, then short term and medium term becomes a neutral scenario, because we are dead in the center. Like, see, if you consider this entire range, we are just in the center of it. We have not done this is not an achievement which a trending market would do. A trend can develop further, but as of now it's in a neutral scenario, so that is a point to be noted. Then where do we think that it might like catch momentum? The momentum would be above this, because if it goes above this test, then it can accelerate. But even if it goes above this and fails, then the chances are that might get rejected and then create balance into this zone. So that is how we develop on the upper side what can be the likely scenario. Then another point to note is there is a failure of this range. It has failed, created this balance and left. So consider this a day and an island reversal. So that also needs to be put into the notes that this has happened. So what can be the likely activity that can happen next? Next, this has already happened. So we already got another scenario that, okay, due to this move shaped up. Now this also becomes an important area. Then if this move has shaped up and we are assuming it to go here, then this becomes an important area. So that way, from the profile chart, we start observing what it does around those levels. From the Renko, we take the references. From here, we take the structure based references. Then we go to volume and see how it did on the 15 minute. Did it create enough demand? Then this looks like the demand had come, started dropping, a bit of selling, but instantly bought in, and the seller stuck below. So this zone where these two HVNs were created and this stuck seller, important references. We need to see what happens here. So from here we got that, and the other information we have got is like we had discussed that volume zones, that this is the first rise. So bottom of that would become a zone, because now we have got another spike into that as well. So this becomes a very good price as a support, and which is already the point of control on this, the volume based point of control. So keeping all this in mind, when the market opens instantly, we start observing, not start trading. So when we observe it for a while, we'll come to know, okay, what it's really trying to do. Now it might happen that the move happens in the first 1 hour itself and we might miss it, but till we get into that momentum into a tempo where we can like instantly do a assessment of what the auction might try to do, till then it's better to like watch it properly. Only when we can answer all the questions arising in the mind, that is the time when we start executing the orders. Not just jump in, and also not get confused with the questions, because see, there can be like the question does not need to be that how far it will go or how much profit it will give. The question should be that if the buyers are doing a good job, what can be the max risk scenario? If we are losing 10 points and there is a likely scenario that the reference is 20 points, we are getting a profit factor of 2. So the R is 2, and that is a tradable setup. But if we are like thinking, will it go there or not? By the time we are finished with those thoughts, the auction has already reached there, and we were like just thinking. So we should also like we can be preemptive and like trade in anticipation, but at the same time not think of what it might do. Like every time it happens that okay, if there is a spike up, now should it go to the point of control? If the point of control is lower, no, there is no such hard and fast rule. It might go, it might not go. If it's rejecting from the higher prices, the point of control is lower, that is a reference. If the odds are in favor that the risk is minimal, the test is over, we create a short, wait for that to come. If it doesn't come, it might give you a hint somewhere in the middle, like on the way to that objective. And when you get the hint, we react to that. Like this move, I was expecting the break of the lows, but like reversed instantly and I could not get into that trade. So now if I start thinking, oh, I knew that this will break and then go higher. Yes, even if I knew, how does it matter? My knowing that it will go higher does not make any sense. Only if I had that time and that kind of confidence to execute along there, then it would have helped. Now at times we might like jump in, or we are able to jump in, and at times we miss it. And if I carry that burden of missing that trade, what will happen is next day I will be thinking about that instead of thinking about the current information. And generally what happens is everyone can easily find the reference areas and how it might behave. But what happens is the mind is looking for too much information, and not just information, it is looking for someone to say that okay, yeah, this is the correct scenario. Now even if I am saying this is the correct scenario, I can like correct on the logic part and my observation part. I cannot still always say what will happen. So even if I am saying something, it's a likely scenario, and maybe I would have observed something and I would give my inputs. That does not mean that if you have done a certain analysis, that is overridden. I'm just adding another input. It's not that my input becomes the final word. Now, like I respect like others who know. I also try to like rely on them that if they are talking something, it is of the information is valuable and I should trust it. But at the same time, we should not lose our own focus, because if the information added is what we are also thinking, it will give confidence. But when it's against, what our mind tends to do is we think that oh shit, I was not able to analyze it properly. Instead of having that regret, we should see that okay, if that is happening, why that level was given, why the input was different, or why did the market do like that. Once we again look back at it and see how it is doing, then becomes much easy. Now this is just the plan as per the uh, intraday and intraday movement of the previous day and the upper and lower reference zones. The starting point would be where is the trend, but for intraday trade it doesn't matter that much. So but still, if we need to trade effectively, then we need to see the weekly chart, then the daily chart. So on weekly we would directly see from the candlesticks, and that all stuff like from this I would like this is like we'll continue in parts, because it's like just one time doing this won't work. So what we'll do is like we'll discuss this, get everyone's views for next day, that what everyone thinks. So we'll everyone can mail a chart, and then what we'll do is again go through those charts and see how it played out. So first, like today during live market, we'll see how it's doing. We have seen the scenarios, and then we'll see how it is doing during the live market. We'll discuss that and record that, and then again next day what we'll do is everyone also does the same thing, that this is the scenario, and then we'll discuss over everyone's scenarios. So I think that's it, and we'll continue this now. I'm naming it like prep 1, because this does not have that information which is like usual. So I'll just name this differently as a uh, Trader Digest, but prep 1. So thanks, and catch you all during the day.